Hello everyone, welcome to Thai Finance. Today I will show you some crisis indicators to predict the severity of the crisis, as well as some historical data about previous crises and the days that it took to hit the stock market bottom, and things that you need to consider if your money is safe at your own bank. So if you think that this is interesting, you should definitely watch this video. I want to start with the 10-year Treasury rate in the United States. This graph can show you in the gray lines all the recessions or economic crises, and this is the yield of the 10-year bond in the United States. So this means that if you can hold a bond for 10 years, it will give you, for example, 6%, 4%, or 2%. So to predict a crisis, normally we can, every time that the curve reverses, there is a possibility that we fall into an economic crisis, like in here or here or here. I will zoom in this part for you to see in more detail. So here we have the last great recession in 2008 and the dot-com bubble. So if you can see here, the bond reversed and here as well, and we fell into an economic recession. And this 10-year treasury rate as well reversed months ago, and we enter now into an economic recession. So the pandemic is not the cause of the crisis. Here we can see that the most important factor about this new crisis is the high yield bond. And we can see in this graph the high yield bond compared with the leveraged loan dried up in the month of March, as you can see here. So people don't want any more bonds because they basically have no yield anymore. The United States have been deleveraging for many years, and they are no longer giving investors a good yield so that they are attracted to invest their money into bonds. So another indicator that can tell you that an economic crisis is coming is the auto sales historical chart, which is the same as the previous one. The gray lines are recessions. And if you can see that if there is a declining sales in the automobile industry, we will fall into a recession as it falls down. And finally, we can see a declining sales as well, and we fall into a recession. And now there was a declining one, and then the pandemic came, and basically all sales went down because nobody's buying cars right now. Another indicator is the oil industry. The oil industry and the oil market is the biggest one in the economy. When oil is not circulating and not basically there are no sales, an economic collapse will come. Here you can see every time there is a contraction in the prices of oil, there are troubles in the economy. And here it was it was huge from 2005 to 2020. This means that we are in big trouble. This will be in the history books. Never in history, in the modern history, was below zero. Nobody wants oil because there's a high supply and a very low demand right now. This will recover eventually, but right now, because nobody's using a car, nobody's traveling because of the pandemic, nobody wants oil. And this is very dangerous because it will slow down everything. And another indicator that can tell you that we're in a deep crisis is the gold price rally. And normally investors use gold as a safe haven. When all the stock market is crashed, you can basically go into gold and have some earnings. And it is considered the only money in the world. And I will tell you later why. Well, finally we get to the time to show you the historical data about previous crises and the days that it took to hit the stock market bottom. So here are listed all the economic crises since 1957, and this is the S&P 500 drawdowns. So you can see the date that of the bottom and the drawdown percentage and the days to get to the bottom. So don't expect the recent economic crisis to hit the bottom yet. We don't know that, and there is low probability that the bottom kicked in just in recent days. So don't expect this to be quick. And this is the days that back to the previous high. So if it fell down at some point, this show you how many days to get to the same height of the drawdown. So I was telling you about the monetary system that we have today. And basically, it is that all the central banks around the world have low interest rates, which leads banks to give a lot of loans with high risk. And this means that if, in order to make money, they have to lend all the bank reserves available. Because, for example, if you take a loan of $100,000 at 2% for 5 years, basically the bank needs to wait 5 years to get the 2% out of $100,000. So this increases high risk bank loans. For banks, it's very difficult to make money with low interest rates because they need to basically lend everything and lend big amounts of money in order to make some profit. So what is the Federal Reserve is increasing the monetary base so that the monetary system doesn't get out of liquidity. And this could lead to inflation, my friends, because prices, when there is a lot of money available, prices tend to go up. And this decreases the purchasing power of people who save in US dollars. Every new dollar that comes into existence takes wealth away from the existing money because there's much more availability of dollars. And all the central banks are basically increasing the monetary base in Europe, in Japan, in the United States, and this is very difficult. Well, I want to show you first the updated chart of the Federal Reserve and the monetary base, and this is basically money printing or just typing a number into the economy, and it has been an unprecedented amount of money injected into the economy since 2008, and compared to other crises in history since 1980, this is just crazy. It's just a lot of money printed out of thin air. This is not creating any value for us. This is just paper. So the US dollar, it might be in a crisis as well. That's why nobody wants bonds. Nobody wants to invest in United States because they are printing money out of thin air. And let's think of it that economic stimulus, it's like fertilizer to a plant. At some degree, the fertilizer will help the plant to grow. But if you put too much fertilizer, you might get this dry earth and kill all the monetary system. You cannot judge a central bank to put fertilizer on the plant. But if it's abused, you only will get dry earth. So the most important thing is that your money might be in danger, maybe, we don't know, but the Federal Reserve declaration on March 26 was this. So basically the board has reduced reserve requirement ratios to 0% effective on March 26, the beginning of the next reserve maintenance period. This action eliminates reserve requirements for thousands of depository institutions and will help support lending to households and businesses according to them. But what does this mean? Every bank must have certain reserves of money in order for your deposits to be secure, because if they lend everything, basically they have no assets. So the Federal Reserve gives the institution permission to reduce the requirement ratios to 0%. And this is very dangerous because now nobody is regulating banks for them to be liquid or for them to have something in their balance sheets. Basically, they can, if you put some money, they can lend everything and be without any assets on their bank accounts. So this is very dangerous for savers because you can no longer trust these institutions if they are backed with some assets or no. So what are doing emerging economies with this problem? We can see that since 2009, countries like Russia, China, India, Kazakhstan, or Turkey, they are increasing their gold reserves by an unprecedented amount. They're doubling the reserves of gold. And this is not new. The pandemic crisis, as they call it, it's not new. This problem has been with us since the past economic crisis. So if you read some history books, gold has always been king, because if empires or monetary system rise and fall, well, gold will always be there and get some value. So in this chart, you can see the total trade and trade balances as percentages of the GDP in the US economy. And well, what is this? I want to tell you that international trade is an important factor in economic growth by allowing for specialization across nations and raising productivity. Trade yields higher growth and standards of living. And you can see that the United States after the 1930s had a surplus in their trade. But over time, the US trade balances moved to persistent trade deficits, with deficits on goods more than offsetting surpluses in services, as you can see clearly in this area. You can see the colors, and you can see that there's more deficits on goods than in services. So these trade deficits were the result of domestic spending, government spending, that exceeds domestic production. This means that they were living above their means of production. So this reflects low savings and higher domestic spendings. That, well, the lower investment lead to lower savings and may slow growth in productivity, the economy, and the standard of living of the American people. And these gray lines is just, well, the total trade of exports and imports. But you measure a wealthy economy by how much they export in comparison to their imports. And well, the United States just has increased their imports from other countries in exchange of currency, which is because the US dollar is an international currency. The United States' ability to service foreign debt is not constrained by the supply of currency earned through exports, but by its income. This means that people buy treasury bonds with the belief that taxpayers in the US economy will pay back their interest. So the income is measured by how many paper gets out of the United States and how much wealth gets from other countries. And this is basically it. They're giving it papers and they're importing products from where? Well, from maybe these economies, because these are the countries that own most of the US debt. For example, China has been exporting an immense amount of products to the United States, and they have basically devalued their currency in order to get those big margins in production. So maybe other economies are in trouble as well, and the whole financial system. And you can see already some signs in Europe. For example, this is just a phrase in order for you to get the image of what's going on in the world economy. This is a speech on the State of the Union in 2018 by Jean-Claude Juncker. And it says, "It is absurd that Europe pays for 80% of its energy import bill, worth 300 billion euro a year, in US dollars when only roughly 2% of our energy imports come from the United States. It is absurd that European companies buy European planes in dollars instead of euro, and the euro must become the face and the instrument of a new, more sovereign Europe. And well, oil prices are as well on the floor, and all the oil is bought in US dollars as well. So it doesn't matter if United States is producing wealth or not, because they can give you paper basically in exchange of products. So what is going on? Why the Federal Reserve can do this? Well, they find the Achilles tendon because according to the Bank of International Settlements, the outstanding amount of dollar-denominated bonds issued by emerging and European countries, in addition to China, has doubled from 30 to 60 trillion between 2008 and 2019. Those countries are now facing over 2 trillion of dollar maturities in the next 2 years. Well, in economies and countries like Mexico or Thailand or even now Great Britain, well, the volatility of their national currencies, it's basically a disaster. Those currencies get devaluated over time, and well, the king of all currencies apparently is the US dollar. But this is only because they trust the country. They haven't seen this presentation. So if the US economy has a huge debt that cannot pay, and basically it's impossible to pay it over the next 10 to 20 to 30 years, unless something big happens, which I don't know. I don't trust buying a bond as well, but people are looking at the US economy and they see that they are spending a lot of money and they are not producing any wealth. They're just giving them paper. So this is another chart that I wanted to show you, which is the federal government debt service and debt. So this includes borrowers' ability to service their debt and how borrowing in each period compares with income. So here we can see two lines. One is the federal debt service ratio and the federal net borrowings to income ratio. So the federal net borrowing to income ratio, which is the orange lines, has been much more volatile. Even at its peak in 2009, which is here, during the Great Recession, it was not much higher than such debt ratios in the past 50 years and remained significantly below the debt ratios created by the large deficits recorded during the World War II and the Great Depression in 1930s. So this is very serious because it's super high. And when the US national income decreases, this tends to go upside, leading to a default on interest payments. And when the government spends on deficit in relation with the national incomes, tends to go up. And this is a 2016 chart. We just hit an economic recession with 6 million people claiming for a new job and the stock market crashing, and this is not a good scenario for the United States. Here you can see the federal surpluses and deficits as percentage of GDP. Everything below zero is a deficit spending, and everything above zero, it's a surplus in the economy. So since 1930, the United States has run a federal budget deficit most years. Higher deficits have generally resulted from economic downturns and war. This is because they can export currency in exchange for goods, and they have the enormous privilege as a leading economy to have their national currency exported everywhere in the world because they trust them. And here is the net savings and net investments as percentages of GDP as well. This is the proportion that people are saving and investing, so it's declining since 1939. And well, this is everything. I hope you really like all the information. It doesn't cost you anything. Please hit that thumbs up. Please subscribe to the channel. Please comment. all the information. What do you think, your thoughts, and maybe question all the information, make further research. I'm not a financial advisor, and this is not financial advice, so you can do whatever you want with this information, but do your own due diligence and be prepared for this economic environment. So thank you very much, and I hope you like it.